This video covers the taxation of individuals with unincorporated businesses, focusing on how to calculate business profits for sole traders and partnerships. We'll explore taxation of business profits, capital allowances, and taxation of partnerships, including basis periods and accounting dates. We begin with the taxation of business profits for a sole trader. A business is statutorily defined as a profession, vocation, or trade. However, this definition isn't sufficient to determine if a trade exists. Instead, the badges of trade, developed in the UK, are used. The badges of trade consider several factors: the subject matter of realization, length of ownership, and frequency of similar transactions all help determine if a trade is being conducted. For instance, frequent transactions increase the likelihood of classifying a taxpayer as a trader. Other factors include supplementary work and marketing, circumstances of realization, and the taxpayer's intention. Additionally, the taxpayer's other activities, the asset's acquisition method, and the financing method are considered to establish if a trade exists. When an asset is bought with borrowed money, especially at a high interest rate, it's highly presumed to be trading stock. The Zambia Revenue Authority generally accepts profits based on accounting principles, but adjustments are often necessary to align with tax legislation, creating taxable profits. Taxable profits are computed by taking the net profit, adding non-deductible expenses and taxable income not yet credited, then subtracting non-taxable income and tax-deductible expenses not accounted for. This calculation yields the final taxable business profits. For an expense to be deductible, it must be revenue, not capital, and incurred wholly and exclusively for business purposes. Capital expenditures like asset improvements and depreciation are disallowed. Repairs are allowed if they restore subsidiary parts, while renewals, which are entire reconstructions, are capital. Appropriations of profits, such as owner's wages and interest on capital, are not allowed. Goods taken for personal use are charged at market value. Trade debts written off are allowed, as are specific provisions for irrecoverable debts. Losses from a subordinate's dishonesty are allowed, unlike those from a proprietor. Normal accountancy and revenue-related legal costs are allowed. Gifts are allowed if they feature a prominent advertisement and don't exceed K100 per customer annually. Business travel expenses are deductible, as are reasonable pension contributions and employee benefits. Income tax on profits is not allowed as an expense. Interest on short-term borrowings is allowed, but not on overdue tax or penalties. Fines are generally disallowed. Subscriptions to relevant trade associations are allowed. Technical education for employees and scientific research expenses are also deductible. Pre-trading expenditure incurred within 18 months prior to commencement, which would have been allowed during trade, is deductible. Trading losses are carried forward for 5 years. Unrealized gains and losses are not taxable or deductible. Foreign exchange gains and losses are generally taxable/deductible only when realized and revenue in nature. Income like rental, interest, royalties, and dividends are taxable at source via withholding tax and are not treated as business profits. Profits from disposals of non-current assets are capital and thus not taxable business income. They must be deducted if credited to profit or loss. Let's examine an example of computing income tax on taxable business profits for Mulongoti, a retail grocer. This slide presents Mulongoti's statement of profit or loss for the year ended December 31st, 2020. We have additional information from Mulongoti's business. This includes details on personal use of business premises and motor car expenses, a breakdown of repairs and renewals, and an irrecoverable account. These details will be crucial for calculating the tax-adjusted profit. Here we see a breakdown of Mulongoti's miscellaneous expenses, including donations, subscriptions, entertainment, gifts, employee payments, and legal fees. Each of these items will need to be evaluated for its tax deductibility. Further information clarifies the charity's approved status, details of the investment sale, goods withdrawn for personal use, gross profit percentage, and Mulongoti's and his wife's salaries. We are required to compute Mulongoti's tax-adjusted business profits for the year. Here's the solution for Mulongoti's tax-adjusted business profits. Since there are no capital allowances to claim, the tax-adjusted profit equals the taxable profit. We add back non-deductible expenses and subtract non-taxable income to arrive at the final figure. The notes explain the adjustments. Private expenses are not allowed, capital expenditure is disallowed, and general irrecoverable debt provisions are not allowed. Entertainment, non-promotional gifts, and goods for personal use are also adjusted. Depreciation is disallowed. and profits on asset disposals and bank interest are non-taxable. Let's consider another question regarding James Muyambango's business. We need to determine how various items charged in his profit and loss account, such as security bars, a written-off loan, and gifts, will be treated when calculating his taxable business profits. Security bars are capital expenditure, so they are disallowed. Loans written off are generally not allowed, unless it's a lending business. Muyambango calendars are allowed as they meet gift criteria. Donations to approved sporting associations are allowed. Reconditioning a machine before use is disallowed capital expenditure. The proprietor's course costs are disallowed. Employee fines and relocation payments are allowed, as are lease rentals for business assets and tax liability agreement costs.